All right, so today we are going to be taking a deep dive into behavioral finance. Basically, like how our minds work when it comes to money
Yeah,
and how that can sometimes lead us astray.
total.
And for this deep dive, we're going to be looking at excerpts from a great book called The Warren Buffett Way.
Classic.
And even if you're not like a diehard Buffett fan,
Right.
this book I think has some really eye-opening insights into,
Oh, yeah.
just the psychology of investing in general.
Yeah, it's really fascinating how
Oh,
we kind of like assume everyone's a perfectly rational actor in the market
right,
when it comes to, making these financial decisions.
right.
But obviously that's not always the case.
Absolutely not. And this book, like right off the bat, dives into that. It
Yeah.
talks about fear and greed being like two of the most dominant emotions
Yeah.
that can really drive investment decisions
For sure.
and can often lead us to do the exact opposite of what we should be doing.
Yep.
Like buying high and selling low.
Absolutely. And Buffett himself,
Yeah.
he talks a lot about how
Yeah.
it's not actually about like having, the highest IQ.
Right.
It's about temperament
Yeah.
when it comes to being a successful investor.
Totally.
And he has this great quote where he says,
Yeah.
unless you can watch your stock holdings decline by 50% without becoming panic-stricken, you should not be in the stock market.
Oh, that's pretty intense.
Right.
Yeah.
Like that's a real gut check.
Yeah, it is. It's like it's easy to talk a big game where
Totally.
the market's going up and everything's great, but like,
Yeah.
can you really handle those big swings without letting your emotions take over?
Absolutely.
So the book kind of goes into, okay, so we've got these emotions of fear and greed, but like what does the opposite look like? What
Yeah.
does like a winning temperament
Right.
actually look like?
Right. And they kind of break it down into these three core traits
Okay.
that are, really inspired by both Ben Graham and Warren Buffett's philosophy.
Got it.
And they are calm,
Okay.
patient,
Mm-hmm.
and rational.
Got it.
And each of these, like, they sound pretty simple on the surface,
Right.
but I think when you really dig into it, there's a lot more nuance there.
Okay, so let's break that down. So
Yeah.
like calm.
Okay, so calm.
What does that actually mean?
It's not just about, like, not selling in a panic.
Right.
Right, like, obviously that's part of it.
Yeah.
But it's also about recognizing that, like,
Yeah.
short-term fluctuations in the market are kind of inevitable.
Yeah.
Like, there's going to be ups and downs.
Right.
And so it's about understanding that
yeah.
the intrinsic value of a business
Mhm.
matters more
Poodles.
than those daily price jumps.
Gotcha.
You know what I mean?
Okay, and then patient.
Patient, yeah.
So like I feel like
Well, if you're thinking about, like, the way Warren Buffett invests,
right.
like, he's very focused on that long game.
Yeah.
And so, when you're thinking long term, you can afford to be a lot more picky. You can say no to, like, a lot of seemingly good deals
Right.
until you find that perfect opportunity.
Yeah. I love that.
Yeah.
And he has that analogy too, right, about the punch card?
Yes, he loves the punch card analogy.
I love that.
So it's like, imagine you have a punch card with only 20 holes on it,
Okay.
and each hole represents like one investment decision you can make
Oh wow.
in your whole life.
That's a good one.
How would that change your approach?
Right, like suddenly the stakes are a lot
It'll
higher.
be a lot more selective.
Exactly. You
Yeah.
wouldn't just like throw your money at
You
anything.
wouldn't just like chase the next hot stock tip.
Exactly. Yeah.
You'd be thinking about like real
Yeah.
conviction and long-term potential.
I love that.
Yeah.
Okay. So we've got calm, we've got patient,
Mm-hmm.
and then the third one,
Is rational.
rational.
Yeah.
Yeah.
And this one I think is
Well, it's a tough one.
a
yeah.
tough one, right?
Yeah.
Because it means like really basing your decisions
Yeah.
on solid research and logic
Yeah.
and not getting caught up in,
Right.
the hype or the speculation.
Yeah. It's like taking a step back
Oh,
and
yeah.
you're like, okay.
Am I being
Yeah.
like swayed by undue optimism or pessimism right now?
Right.
Or am I actually like
Yeah.
thinking clearly?
Yeah. Are you letting your emotions dictate your actions?
Exactly.
Or are you actually like
Yeah.
looking at the facts?
Totally. And this actually leads us really nicely
Okay.
into one of the most famous
Yeah.
concepts from Ben Graham,
Okay.
which is Mr. Market.
Mr. Market. I love this one.
This is a good one.
Okay. So for anyone who hasn't heard this one before,
Yeah, explain Mr. Market.
lay on us.
So imagine Mr. Market is like this business partner you have,
Okay.
and he's like
Yeah.
kind of a whack job.
Okay. Got it.
He swings wildly between like manic excitement
Okay.
and like crushing despair.
Got it.
And every single day he comes to you and he's like, hey,
Hmm.
I want to buy your share of the business.
Okay.
Or, hey, I want to sell you my share of the business.
Okay.
And the price he offers you is based purely on his mood that day.
Okay.
It has nothing to do
No,
with the fundamental value of the business.
So he could be like euphoric one day.
Oh, totally.
And be like, I'll give you $1 million.
Yeah, $1 million
For the thing.
one share.
Yeah.
And then the next day.
And the next day he's like crying.
Yeah.
He's like, please take this off my hands. I'll give it to you for $10.
And it's the same thing.
It's the same thing.
Wow.
And the point of the allegory is,
Yeah.
don't let his emotional roller coaster ride dictate your actions.
Right.
You have the power to choose when to engage with him and when to walk away.
I love that.
The real skill lies in recognizing when he's being foolish and using that to your advantage.
That is such a good way of looking at like market swings.
It's like it really helps you separate your own judgment from all the noise and the frenzy that's happening.
Yeah.
Okay, so we've talked about fear and greed. We've talked about these two tracks or these three, core traits of temperament.
Yes.
But I think we also need to acknowledge that even like seasoned investors aren't immune
Oh, absolutely not.
to making like irrational decisions.
Yeah.
And this is where I think Charlie Munger,
Yeah.
Buffett's longtime partner,
The brains behind the operation.
he comes in. Yeah. He's fascinated by what he calls
He calls it the psychology of misjudgment.
Yes, which I love.
That's such a good term.
Yeah.
He believes that like understanding our biases is key to making better choices.
For sure.
And one of his big things is this concept of two-track analysis.
Yes.
So break that down for me. Okay, so two-track analysis is basically like you're considering not only rational factors that go into a decision, right? So like the financials, the market conditions, all that stuff, but also the less obvious like subconscious influences.
Oh, so it's like those two things.
It's like you've got two parallel tracks running in your mind. One is like the logical, analytical track, and then the other is the more instinctual, emotional track, driven by like our biases.
All those like hidden things that we don't even
the things we might not even realize are influencing us.
Yeah, totally.
Yeah.
So it's not enough to just like crunch the numbers.
Exactly. You got to be aware of those like hidden emotional currents that might be like pulling you in a different direction.
Okay, so we've talked about fear and greed. We've talked about
two tracks of thinking.
These two tracks of thinking.
Yeah.
But I think the book also goes into like specific biases
for sure
that can really trip people up.
Yeah.
And like one of the big ones is overconfidence.
Overconfidence is a classic.
It's a classic.
Yeah.
And they talk about
well, think about it this way.
Yeah.
Like studies show that most people think they're above average drivers.
Yeah.
Which statistically is impossible.
Right.
But it just highlights like our natural tendency toward overconfidence.
Totally.
And so when you bring that into the investing world, that can lead us to like take on too much risk.
Right.
Or make impulsive moves.
Yeah.
Without doing proper research.
No, it's not just about thinking you're like a genius stock picker.
Exactly.
It's about like recognizing that we all have blind spots. Well, even the most experienced investors can and
do make mistakes.
Absolutely.
And this actually ties into another bias.
Okay.
Which is overreaction.
Overreaction.
Yeah. We tend to place too much weight on recent events.
Okay.
Especially negative news.
Yeah.
So like if a company releases one bad earnings report, investors might just like totally panic and dump the stock assuming the worst without really considering the company's long-term prospects.
Yeah, it's like that knee-jerk reaction you have when you see a spider.
Yes.
Even if it's like totally harmless, your brain just goes into
fight or flight.
Yeah,
fight or flight
before you've even like processed what's happening.
Yeah.
Yeah, I love that analogy. So it's like you really gotta
totally
take a breath. Yeah. Assess the situation.
Look at the bigger picture.
Yeah.
And interestingly, Hagstrom mentions this study by Richard Thaler, who's like a pioneer in behavioral finance.
Okay.
And he found that investors who check their portfolios less frequently
interesting.
actually made better choices.
Really?
Yeah.
So like less information.
Sometimes less is more.
Wow.
Yeah, because it suggests that like that constant monitoring of those short-term fluctuations can actually like amplify those emotional responses and lead to those overreactions.
Yeah, totally makes sense.
Yeah.
That's so interesting.
It's a good reminder to like tune out the daily noise and focus on the bigger picture.
Okay. So we've got overconfidence. We've got overreaction.
Yeah.
The next one I think is super relatable.
Oh, yeah.
Which is loss aversion.
Loss aversion.
Like this one is just so human.
It's so primal.
Yeah. It's that feeling that like losing money hurts way more.
So much more.
Than gaining the same amount feels good.
Way more.
Which doesn't make any logical sense.
No, it doesn't.
But it's just like how our brains...
It's just how we're wired. Yeah.
So how does that play out like in the investing world?
Well, it can lead us to like hold on to those losing investments for way too long.
Oh, yeah.
Hoping they'll bounce back.
Yeah, you're just like, no. Yeah. It's going to come back.
It's going to come back.
I just got to wait it out.
Yeah.
But it's like that old T-shirt in the back of your closet. Exactly. Like, no.
One day it'll come back in style.
It's going to come back in style.
Yeah.
It's a classic.
Yeah, totally. But in the investing world.
Refusing to cut your losses can actually prevent you from reallocating your capital to those more promising opportunities.
It's just like stuck.
You're stuck.
Yeah. So it's about knowing when to like...
When to fold them.
Yeah, fold them and move on.
Yeah.
Even if it stings a little bit.
Even if it hurts. Yeah.
Which is why things like stop loss orders can be really helpful.
Yeah, explain though.
So basically it's like you set this threshold and if the price of your stock drops below that, it automatically sells.
Oh, wow.
So it like takes the emotion out of it.
I like that.
Yeah.
Okay. So it's like a pre-commitment.
It's a pre-commitment.
Yeah.
Yeah, exactly.
Okay. So we've got overconfidence. We've got overreaction. We've got loss aversion. The last one I want to touch on is mental accounting.
Mental accounting. Oh, this one's so fascinating.
I know this one's so subtle.
It's so subtle.
But it like really affects like...
But it's everywhere.
Yeah. Okay, so explain mental accounting.
Okay. So it's basically the tendency to like mentally categorize money differently, even though it's all ultimately...
Right, it's all the same.
It's all the same.
Yeah.
It's all coming from the same place.
Yeah, like why is it...
So like explain why we're more likely to like spend a bonus check on a fancy dinner than money we've like diligently saved from our paycheck.
Totally. Like it's the same money.
It's the same money.
Yeah.
But it feels different.
Right. It feels like found money.
It's like found money.
Yeah.
It's like, oh, this is like extra.
Yeah.
This is play money.
It's like guilt-free spending.
Guilt-free spending, exactly.
Yeah.
Yeah.
But like rationally, it makes no sense.
No, but our brains don't always work rationally.
No, they don't.
And the book gives that great example of finding a $20 bill in your pocket.
Yeah.
Like you're like...
It's like you won the lottery.
Yes. It's my lucky day.
Yeah. Even though like it was technically yours all along.
It was yours the whole time.
But it just feels different.
Yeah. It feels like a windfall.
Yeah.
Yeah.
And so this plays out in investing too, right?
Right. Totally.
Like
people might be more willing to like take risks with profits from a recent win.
Oh, yeah.
Because they see it as like house money.
Yes.
It's like, no, this isn't really my money.
Exactly.
This is like the casino's money.
It's like play money.
Yeah. Yeah, totally.
Even though, again, it's all the same.
It's all coming from the same account.
Yeah.
Yeah. That's so interesting.
Yeah.
Okay, so
we've got all
these different forces at play.
Yeah, we've got our emotions.
Yeah.
Fear and greed kind of driving our decisions, often subconsciously.
Right.
We've got those two tracks of thinking, the rational and the emotional, constantly kind of like...
battling it out.
Yeah, battling it out for control.
Yeah.
And then we've got these specific biases.
Right.
Overconfidence, overreaction.
Loss aversion. Mental accounting.
All
skewing our judgment.
Yeah, skewing our judgment.
Yeah.
It's a lot.
It's a lot to process.
Yeah, it is. It's a lot to process.
Yeah.
So before we dive into part 2, where we're going to be talking about risk tolerance and looking at how Warren Buffett kind of embodies all these principles.
Looking forward to it.
Yeah, I want to hear from you.
Yeah.
What's resonating with you so far?
Totally.
What are your like aha moments?
Yeah.
What are you starting to like question about your own financial habits?
Exactly. Let us know.
It's funny. You know, we've been talking about all these biases.
Yeah.
As if they're like these separate things.
Right.
But they're all so intertwined.
Totally.
And one of the areas where I think this really comes to life is with risk tolerance.
Oh, yeah, risk tolerance.
Yeah, because we tend to think of risk tolerance as this, like, fixed personality trait.
Right, you're either like a daredevil or you're
like super risk averse.
Yeah, playing it safe.
Yeah.
But it's not that simple, right?
No, it's way more fluid than that.
It's not just about, like, who you are as a person. It's also about, like, the context you're in.
Totally.
Like, think about it when the market's booming and everyone seems to be making money. Suddenly, even the most conservative investors might feel tempted to, like, chase those hot stocks.
You get FOMO.
Total FOMO.
They're like, oh, I got to get in on this.
Yeah, like everyone else is making money. Why am I just sitting here?
Exactly.
It's like that feeling you get when you're on, like, a winning streak at the casino.
Yes.
You suddenly feel invincible.
You're like, bring it on.
Yeah.
I'll bet it all.
Yeah. Double down.
Yeah, exactly.
Even if you wouldn't normally do that.
Right.
And then when the market takes a dip, those same people might become, like, overly cautious, scared to lose anymore.
They're like, oh my God, I gotta, like, pull everything out.
Okay, get me out of here.
Yeah.
Even if it means missing out on, like,
good opportunities.
So it sounds like risk tolerance is really this, like, constantly shifting variable.
It's dynamic.
Yeah.
It's influenced by both, like, our internal state and the external environment.
Yeah, I love that.
And this is where I think all those biases we've been talking about come back into play.
Okay, so how does that work?
So, like, overconfidence might lead us to, like, underestimate the risks involved in a particular investment.
Right. We're like, I got this.
Yeah, I've done this before. Yeah. I can handle it.
No big deal.
Even if we're venturing into territory we don't fully understand.
Yeah. And then on the flip side, loss aversion can make us, like,
super cautious.
Yeah, overly cautious.
Yeah.
Even when, like...
Even when the potential rewards might outweigh the potential downsides.
We're just so scared.
Yeah. We're so focused on, like, not losing...
Avoiding those losses.
That we miss out on.
Yeah. The potential gains.
And it's not even just about, like, our general attitude toward risk.
Yeah.
It's about, like, how that risk is presented to us.
Exactly. Like, the framing.
Yeah.
Can totally change our perception of it.
Totally.
For instance, like, studies have shown that people are more willing to take risks to avoid a loss than to achieve a gain.
Interesting.
Even if the outcome is the same.
Wow. So it's like...
Yeah, it's like we're wired to feel the pain of a loss more acutely than the pleasure of an equal gain.
So it's all about, like, how it's framed.
The framing is everything.
Yeah, that's fascinating.
It really is.
Okay.
So, yeah, I think it's so important to, like, really develop a deep understanding of your own risk tolerance.
Okay.
Recognizing that it's not static.
Right.
But rather, like, this dynamic interplay between your personality, your financial goals, and the ever-changing market landscape.
Right. Because all of those things are, like, in constant flux.
Totally.
Okay, this is a lot.
It's a lot.
We've got emotions, we've got biases, we've got this shifting risk tolerance.
It can feel like a minefield out there.
It does. It feels like a minefield. Okay, but there's got to be a way to, like, navigate this.
So the good news is the more aware we become of these psychological forces, the better equipped we are to navigate them.
To make better decisions. And I think this is where, like, the example of Warren Buffett becomes so helpful.
He's like the master.
Yeah. Because throughout the book, we see, like, how he manages to stay so grounded and make rational decisions.
Level-headed.
Yeah. Even when
everyone else is losing their minds.
Yeah, the market's going crazy.
Totally.
He's just like...
He's chill.
Yeah, he's like, nope.
Yeah.
I'm sticking to my plan.
He's not like some superhuman who's immune to emotions.
Yeah.
But he's clearly, like, mastered the art of controlling them.
Yeah, like, he doesn't let fear and greed drive his decisions.
He's got that long-term vision.
Yeah. He's so patient and disciplined. Yeah. Like, he's willing to wait for the right opportunity.
Absolutely.
Even if it means missing out on, like, short-term gains.
Short-term noise.
Yeah, it's like he's internalized that punch card analogy.
Totally.
Like, every decision
matters.
Is, like, so important.
He's so selective about where he puts his money.
And he's also, like, constantly learning, right?
Always.
Like, he's always seeking out new information.
New perspectives.
New perspectives, which I think helps him avoid that trap of overconfidence.
Totally.
He's constantly
challenging his assumptions.
Okay, what am I missing?
Like, don't I know?
Let me, like, get more information. Right. It's interesting that even someone like Buffett,
who was like at the top of the game,
still prioritizes that.
Yeah.
Like it's
a good reminder that like no matter how much we know, there's always more to learn.
Yeah. Humility is so important.
Humility's key.
Especially when it comes to like...
Especially with the market.
Yeah, the market, because it's so...
It's so
complex.
Yeah.
Okay, so he's patient, he's disciplined, he's constantly learning, but he also... like uses the market's...
irrationality to his advantage.
Yeah, to his advantage.
Yeah, he's often buying
Yeah.
when everyone else is panicking.
Right. And selling when everyone else is euphoric.
Yeah, he's basically like playing Mr. Market at his own game.
He's like, all right, Mr. Market, I see what you're doing.
Yeah.
I'm going to use that to my advantage.
I'm one step ahead of you.
Yeah. So he's not just avoiding these psychological traps.
Right.
He's like
leveraging them.
Leveraging them to create opportunities for himself.
Yeah, he's turned behavioral finance into a superpower.
It's like a superpower.
Yeah.
Okay, so we've talked about the theory, the biases.
Yeah.
I've even seen how someone like Buffett puts it all into practice.
Right.
But I want to like shift gears a bit and ask, have you noticed any parallels?
Ooh, that's a good question.
Between these principles of behavioral finance and other areas of your life?
That's a really interesting question.
Yeah.
I think the answer is yes.
Yeah.
Like the same biases that trip us up
in
the financial markets can also influence our choices in our relationships, our careers, even our everyday decisions.
Like it's all connected.
All connected.
Yeah. So give me an example.
So like overconfidence can lead us to take on more than we can handle at work.
Totally.
Or to make promises we can't keep in our personal lives.
Right.
And then loss aversion might prevent us from ending a relationship that's no longer serving us.
Right. Or leaving a job.
That's
making us miserable, even though we know it's the right thing to do.
We're so afraid of that potential loss.
That's the loss.
Yeah.
That we just like cling to the familiar.
We cling to the familiar.
Even if it's hurting us.
That's
so powerful.
Yeah, it's amazing how these like seemingly abstract concepts from behavioral finance can suddenly become so personal and relatable.
It's like you're holding up a mirror to your own decision.
Your own life.
Yeah. And you're like, oh, wow.
Oh, I do that.
I do that all the time.
Yeah. And that awareness is so powerful.
Yeah.
Because it gives us the opportunity to make more conscious choices.
Right. We're not just like reacting to our emotions.
We're not on autopilot anymore. We're actually like...
We're taking control.
Yeah. Taking the reins.
Yeah. I love
steering our lives in the direction we want to go.
So this isn't just about like... becoming a better investor.
Yeah.
It's about becoming like...
It's about personal growth.
Yeah. More self-aware.
Yeah.
More intentional.
In all areas of our lives.
Yeah. In all aspects of our lives.
Yeah. I love that.
Okay. So we've covered a lot of ground. We've talked about, you know...
the theory.
The biases. How they show up in investing.
Yeah. And even in our like...
in our personal lives.
Yeah. So before we get into our final thoughts and takeaways, I want to hear from you again.
Yeah.
What are some of the most like surprising or insightful things you've learned so far?
Yeah.
Are you starting to see
any of these biases play out in your own life? And what are some of the strategies you might start using to like navigate these psychological pitfalls?
Yeah. What are your takeaways?
Yeah, let us know. So we've really been on quite a journey with this deep dive into behavioral finance.
Yeah, we've uncovered a lot about how our emotions and biases and even our perceptions of risk can really kind of derail our financial plans.
Yeah, and we've seen how like legends like Warren Buffett not only acknowledge these things, but use them to their advantage.
Exactly.
So I guess the question becomes like, as we wrap up our deep dive into the Warren Buffett way, how can we apply this to our own lives?
Yeah, how we move from like theory to action.
Yeah. What are the takeaways?
Well, I think it starts with awareness.
Okay.
Like we've spent this whole episode kind of peeling back the layers of our own psychology. So now it's about using that knowledge to make more conscious and informed decisions.
So it's like we've been given this toolkit.
Yeah, think of it like a toolkit.
Yeah.
Filled with all these strategies to combat those like impulsive urges.
Those knee-jerk reactions.
Yeah, those knee-jerk reactions. And again, it's not about becoming like emotionless robots.
Yeah.
Right? Like emotions are...
They're part of what makes us human.
Part of what makes us human, exactly.
Yeah.
But we can develop a system.
Okay.
Like a set of checks and balances.
Yeah.
To prevent those emotions from leading us astray.
So what would that look like?
Well, it might involve like setting clear investment goals.
Okay.
And sticking to them. No matter how tempting it is.
Right.
To like chase the latest market fad.
Right, like having a plan.
Have a plan.
Yeah.
Stick to the plan.
And like doing your research.
Yeah, do your research before you just like jump into something.
Yeah. Instead of getting swept up in the hype.
Don't get FOMO'd.
Don't get FOMO'd.
Yeah.
Yeah, and I think we also talked about the importance of like seeking out diverse perspectives.
Yes.
And challenging our own assumptions.
Constantly challenging those assumptions because that's a powerful antidote to overconfidence.
I was like, okay, what am I missing here?
What don't I know?
Let me get some other opinions.
Exactly.
Yeah.
And of course, we can't forget about the importance of patience.
Patience.
That long-term mindset. Remember Warren Buffett's famous quote?
Yeah.
Someone's sitting in the shade today because someone planted a tree a long time ago.
I love that.
It was such a good one.
Yeah.
And it really captures like the essence of patient investing.
So as you continue on your own investing journey, think about these things.
Yeah, pay attention.
Pay attention not just to like the numbers.
Yeah, not just the numbers.
But like your own thoughts.
Your feelings.
Behaviors.
Are you making decisions based on like...
fear and greed?
Yeah, fear and greed.
Or are you actually like...
Or are you being rational? Looking at the data.
Yeah. Are you getting caught up in Mr. Market's mood swings?
Right.
Or are you charting your own course?
Based on like your own goals.
Your own goals.
Yeah.
Your own risk tolerance.
Because at the end of the day, the most successful investors aren't necessarily the ones with like the highest IQs or the most sophisticated
algorithms.
Yeah, algorithms. It's about the psychology.
It's the ones who've mastered the psychology.
Yeah, they understand themselves.
Yeah.
They understand their biases.
Yeah.
And they understand
the market.
The market.
Yeah.
That's the power of behavioral finance.
It's a major power.
It's a superpower.
Yeah. It gives you the tools.
It gives you the tools
to be more self-aware.
More disciplined. And ultimately more successful.
With your money.
With your money. Yeah.
So keep exploring.
Keep learning.
Keep learning and keep diving deep into this world of behavioral finance.
It's fascinating stuff.
It is fascinating.
Yeah.
And until next time, happy investing.